All right, guys, I'm going to make qualifying for a home here a lot simpler than you think here. I'm just going to run through everything you need and just based off roughly a $400,000 home value. So to qualify for a home, you need three things. You need credit, savings, and income. So number one, with the credit, you just get your credit pulled. Now, I do that for you. You don't go get your credit pulled and then send that to me. But what you have was what you have, okay? No real suggestions for you before the pull. But after the pull, I might have some ways for you to improve your credit, especially if you got some outstanding credit card balances. I could give you some ways to improve that short term, long term, whatever. But if your credit score comes in, I got a bunch of stuff on credit here. What minimum credit score is usually required and for what types of products. Usually 620. That you start to be in the ball game there. Once you get over 680, 700, and the higher you get, the better. But savings, so some programs, you don't even need a down payment, but figure that part out. 401k takeouts, pulling money out of your retirement, it's very popular for this. Usually you don't want to touch money set aside for retirement, but if that money is going to help make you more money, then maybe it's right for you. Look, 70% of my first-time buyers in 2024 didn't bring their down payment, okay? They got a VA veterans loan, or they got some zero down loan program, or they brought a gift from family. Again, you do not need one. What's more important is you get a house first before even having a down payment, in my opinion. All right, you don't wait to buy real estate. You buy real estate and then wait. Okay, over time, the home value builds. Soon you'll have the equity that those people that bought with 3% and 5% down, those buyers had on day one. Sometimes it does not take long for you to build that yourself. So 6 to 7% is the average down payment used for first timers, and a lot of that comes from family gifts. And that 6 to 7% statistic I just mentioned, it gets inflated by their mommy and daddy's money. So, but just for you guys, I'm going to tell you, let's start with 0% down and then see what else you can grab. Closing costs, assume 3%. No, it's possible a seller could pay for some, but let's not assume you'll get any yet. That happens in negotiations for the home you want to buy. Your agent takes care of that. But let's assume 3% for a $400,000 property, aka $12,000. I always tell people that $20,000 is a nice target for your own savings to have outside of your 401k, the gifts, takeouts. But you probably don't even need that much to start with. It's just a good target I like to give people. The third thing is your income. Your income is really measured by what's called your debt to income ratio. We'll get to that here in a second, but your income, we're going to take a look at your most recent pay stubs. Okay, so see what your employer pays you every month on their regular base salary. And then if you want to add your overtime, bonus, commission history, I got to see a 2-year history of that. So I'd take, now is the 2025 year, so I would basically ask you for your end of year pay stubs for 2023 and 2024, showing all of that, secondary or what we call variable income that you made to get a 2-year receipt of that. And then I average that out. And then if you're self-employed, got to get your tax returns to get your total income. Most people are going to need 2 years of tax returns for self-employed, but if you've had your business for over 5 years, really only need 1 year of tax returns. But let's say your income is $8,000, okay? So debt to income ratio, you're comparing your income to your debts, all right? So let's say your debts, your principal, interest, taxes, insurance, and possibly also mortgage insurance or HOA fee and condo fee. These are the things that are going to make up your housing payment. We're going to estimate this for now when you get pre-qualified. So let's say, just hypothetically, in your new home, you're going to have a $2,600 principal interest, $400 a month for taxes, $100 for insurance, and $100 for the other category there. So you get a $3,200 housing payment. Then you're going to add that to the other minimum payments from the debts that are coming on your credit report. So when I pull the credit report, I get these debts and I add this into the debt to income ratio calculation. So let's say you got a $350 car payment, $100 student loans, $50 credit card. So you got $500 miscellaneous debt. You got to add in any other monthly private loans you got, alimony, child support, spousal support payments you got to make. But let's assume you got none of those. So your housing payment plus your car payment, student loans, credit cards, that equals $3,700 total. So the ratio now is $3,700 in monthly debt divided by $8,000 in monthly income equals 46.25%. This is good. And on a zero down loan with a higher principal and interest, you're doing really well. And you might have to bring that back a little bit, make it easier on yourself. But if you have a debt to income ratio there, 46.25, most programs are going to allow that. Most programs will usually go up to at least 49.99%. That's really, I'm talking about conventional conforming loans. Now, it's all based on what the algorithm says. Sometimes if the algorithm at Fannie or Freddie, they don't like all the pieces of your financing, they might bring you back down maybe to 45% or 43% or 40% of a max debt to income ratio. But most of the time, conforming loan, under 50% debt to income ratio, you're good. If you got to improve that, you can look for a cosigner, get mom or dad on the loan, have more income added on there for you to qualify. You could pay down or pay off other debts. You could refinance other debts. You could pay down your rate. There's a bunch of other stuff. But if you needed to improve that debt to income ratio, get that under 50% or whatever the algorithm says that you need to get under. So you now have all three. You have your credit, your savings, your debt to income ratio. You throw it into the hopper. This is the Fannie Mae, Freddie Mac automatic underwriting system. It comes back to us. I literally just push a button, send your financing file to their servers in DC, and it comes back in real time, like bam, like right away. And then you get an initial approval. Awesome. So basically you're there. And then let's say you have some savings, right? Let's say you have $40,000 more than before. Well, then you lower your payment by a hypothetical, let's say $250. So now your payment is not $3,200 a month, it's now $2,950 a month. You can basically alter, edit this stuff, as it fits to whatever your scenario is. But boom, that's it. It's that easy. You're ready to go make offers. I need to see your credit report. I need to see your pay stubs, and I need to see how much you have in savings. You really just got to tell me that. And then, you can go out and shop around realistically, knowing with that Fannie Mae, Freddie Mac approval that I just gave you, that, you're not going to be wasting your time out there looking for houses that you can't actually get approved or qualified for. But after you go under contract, that's when the formal approval and the appraisal happens. But after you do this, honestly, you're pretty much a shoo-in for the final approval unless something drastic doesn't happen or, some extra third-party item comes in and blindsides you. But guys, that's how you qualify. I got an awesome, fantastic first-time buyer playlist in the playlist section of this. If you don't know anything about mortgage underwriting, or if you want to know more about the mortgage process, that's where I'd go if I were you. It's going to teach you everything I would want to know if I didn't know any of this stuff at all. And see you guys over there. Thank you.